Welcome to another exciting episode of Financial Insights in Minutes. Is the economy on the brink of disaster? We'll break down the latest updates on the housing market crisis and predictions of a stock crash.
Plus, we'll explore China's economic turmoil and its global implications. This is vital, so stay tuned.
Don't miss this critical financial news review. Your wallet could depend on it. Discover how to safeguard your investments in these turbulent times.
We'll also summarize the day's top videos from the leading financial minds. Stay until the end for a breakdown of where our experts agree and disagree.
ClearValue Tax reveals why home prices have hit a new record high. Game of Trades dissects Michael Burry's alarming financial bets. Eurodollar University dives into China's dollar shortage crisis. Julia Roche hosts David Wu discussing market misconceptions on the Trump trades. Thoughtful Money's Jan Van Eck outlines 4 macro trends driving markets. David Lin explores the political bombshell of Biden's potential resignation. Blockworks Macro's Chris Whalen on banks cleaning house of bad assets. Bill Baruch on how Biden's withdrawal impacts gold, stocks, and Bitcoin. Welcome to another exciting episode here on ClearValue Tax. Today's hot topic: how high can home prices go? Spoiler alert, they've broken another record. We'll explore the latest data and debunk some persistent myths.
Absolutely. Brian Kim dives into the nitty-gritty details of the latest housing market figures. Buckle up, we've got some real eye-openers for you.
All right, let's get to the core of today's discussion. What's Brian Kim's main point here?
The central claim is that despite hitting another record high in home prices, we're not seeing a housing market crash. Brian argues that the market is much more stable than sensationalists want us to believe.
Let's drill down into the specifics. What does the data say about home prices?
June data shows that home prices have hit a new record high again. Median sale prices are up by $289 month over month and have increased by 4% year over year. So things are definitely heating up, but not crashing.
And what about all those crash predictions we've been hearing for years?
Brian Kim points out that people have been predicting a crash for 3 years now without it happening. Even in markets like Texas and Florida, where inventory is rising, the price drops aren't enough to justify the term crash.
Let's talk about inventory. What's going on there?
Current inventory stands at 1.77 million homes, slightly up from last year's 1.56 million. Even so, we're still 25% down from pre-pandemic levels of 2.38 million. So low inventory is keeping those prices high.
And what's the latest on mortgage rates?
The average 30-year fixed mortgage rate is at 6.8%, within a stable range between 6% and 8%. The Federal Reserve predicts modest rate cuts starting in September, but don't expect massive drops just yet.
Any interesting migration trends?
People are moving away from big cities like Los Angeles, New York, and San Francisco, heading instead to places like Texas and Florida. The migration continues, but at a cooling pace.
What does Brian forecast about the future then?
As for mortgage rates, they're expected to dip slightly as the Fed begins cutting rates, likely staying in the higher 5% to lower 6% range by early 2025. Home prices are anticipated to remain stable with no major swings.
Any thoughts on housing affordability?
Unfortunately, significant improvements in housing affordability are unlikely in 2024. Better prospects could emerge by late 2025.
So, what's the final verdict?
Brian Kim concludes that despite current challenges, a housing market crash isn't imminent. Future rate cuts might provide some relief, but substantial affordability will take time. Stay tuned for more realistic and honest updates.
Welcome to Game of Trades. We've got a riveting topic today: Michael Burry's latest investment moves. The guy who predicted the 2008 financial crisis is at it again, and it looks like he's sounding the alarm for another economic storm in 2024. Hang tight as we break it down.
Absolutely. Burry's been shaking up his portfolio in a big way. We're talking massive sales of U.S. tech stocks and a pivot to Chinese tech firms and gold. It's a strategic play that screams caution, and we're here to unpack what that means for us all.
So what's the main gist of Burry's moves? Why such a dramatic shift?
Burry's bracing for economic turbulence. He's sold off a big chunk of his U.S. tech stocks due to their sky-high valuations and shifted to bargain bin Chinese tech stocks and gold. Essentially, he's betting on safer and potentially more lucrative opportunities.
Let's talk specifics. What did he sell, and why does it matter?
Burry offloaded $50 million worth of stocks, including big names like Amazon, Alphabet, and Oracle, which were about 15% of his portfolio. These stocks have high PE ratios, reminding us of the dot-com bubble. The valuations are just too high.
Interesting. And what did he buy?
He went on a buying spree of Chinese tech stocks, JD.com, Alibaba, Boeing, to name a few. They're dirt cheap right now compared to U.S. stocks at levels we haven't seen in over 15 years. Burry's betting they'll rebound.
Tell me more about the U.S. tech stock valuations.
Large-cap U.S. tech stocks have a PE ratio of 30, while the average is 15. Investors are paying double for tech compared to other sectors. Burry's cautious about these inflated prices.
And Chinese tech stocks.
Despite 6 years of declining earnings, these stocks are super cheap. Burry's betting on a turnaround that could see Chinese tech outshine U.S. tech, similar to spikes we've seen in past years.
And gold? What's Burry thinking there?
He bought into Sprout Physical Gold Trust, around 7% of his portfolio. Gold shines in economic crises, like in the Great Depression, the 1970s, the early 2000s, and during the 2020 pandemic. Burry's clearly expecting trouble ahead.
All right, so what does Burry see in the crystal ball?
He predicts economic challenges and is focusing on gold and undervalued foreign stocks as safe bets. If Chinese tech earnings turn around, his investments there could seriously outperform U.S. tech.
So, what's the big takeaway here?
Burry's moves suggest it's time to think strategic. Consider undervalued opportunities and safe haven assets like gold to brace for potential economic turbulence. It's a wake-up call for investors.
Welcome to the Eurodollar University YouTube channel. In today's episode, Jeff Snyder dives deep into China's perplexing dollar shortage and its repercussions on the global economy. Buckle up, because we're about to unravel a financial mystery that's more twisted than a pretzel.
Exactly. Jeff Snyder, our financial sleuth, is here to dissect the enigma of China's dollar shortage and its cascading effects. Let's get ready for a wild economic ride.
So what's China's big economic headache all about?
The heart of the matter is a severe dollar shortage that's impacting China's banking and bond markets in ways we've never seen before. Jeff argues that this isn't about interest rates, but deep-rooted problems in the Eurodollar system, forcing China to take desperate measures.
Let's break it down. How is this dollar shortage manifesting in China?
First off, China's dealing with a weak currency and showing unprecedented activity in its bank funding sector. The People's Bank of China, or PBOC, recently slashed credit rates, signaling high anxiety in Beijing.
What's the deal with these currency swaps Jeff mentioned?
Currency swaps are where dollar providers lend dollars for foreign currency, then invest that currency. The desperation has reached a level where overseas institutions are heavily invested in Chinese negotiable certificates of deposits, or NCDs.
And how's this affecting their economy overall?
Imports have decreased, while exports are barely growing, resulting in a record merchandise trade surplus. And China's GDP growth and key economic metrics like industrial production and retail sales are hitting rock bottom.
Panic mode for the PBOC, huh?
You bet. They've slashed their 7-day repo rate and loan prime rates in a bid to inspire confidence. But Jeff argues these cuts are more about psychology than real economic benefit.
Time to gaze into the crystal ball. What are we looking at for the future?
Expect continued risk aversion from global dollar providers, meaning they'll demand higher premiums to supply dollars, worsening the shortage. And don't hold your breath for a quick recovery. China's real estate and broader economic issues aren't going away anytime soon.
All right, wrap it up for us. What's the bottom line?
Jeff wraps up by emphasizing that China's dollar shortage points to bigger systemic issues in the global Eurodollar system. To tackle upcoming economic uncertainties, he underscores the need for better understanding of these inherent challenges. Solid advice for anyone watching the economic forecast.
Welcome to the Julia LaRoche Show on YouTube. Today's highlight is David Wu, the astute prediction maestro who nailed the 2016 and 2020 elections. Wu's here to clarify some market misconceptions about the so-called Trump trades. Brace yourselves for some insightful analysis.
Absolutely. Wu's perspective is invaluable, especially considering his credentials as CEO of David Wu Unbound and his accurate past predictions. Shall we dive into the meat of the discussion?
So what's the main argument David Wu is bringing to the table?
David argues that investors are prematurely banking on a Trump win in the 2024 elections and gearing up for what they call Trump trades, expecting higher growth and tax cuts. But he believes this assumption is jumping the gun given the early stage of the election process and various uncertainties.
Let's discuss the key points he brings up, starting with the economic landscape. What's the current state?
The macroeconomic environment is rife with uncertainty. The Fed, alongside investors, is adopting a wait-and-see approach. Retail sales were stronger than expected, which has pushed any anticipated rate cuts to September.
And on the geopolitical side?
Geopolitically, actions are being influenced by the potential outcomes of the U.S. election. For instance, Putin might be slow-walking the war in Ukraine, anticipating Trump's return.
Interesting. So what about the market's assumptions on Trump trades?
Many investors are betting on a repeat of 2016's Trump trades, expecting lower taxes, faster economic growth, and a rising dollar. David cautions that these assumptions are faulty due to the vastly different economic conditions between now and then.
Right, and how about the fiscal constraints David mentions?
The U.S. fiscal situation has deteriorated significantly, with the budget deficit rising from 3.2% to 6.7% of GDP. Even proposed tax cuts would merely keep current low rates permanent, providing little real benefit to individuals.
Tell us about the predictions David makes.
David predicts several political risks, including the potential for another assassination attempt on Trump, Biden possibly dropping out of the race, and the risk of a global trade war due to potential tariffs.
And market consequences.
Market volatility could spike, gold prices might hit new highs due to trade wars and political uncertainties, and there's a looming risk of a recession if the AI profit bubble bursts.
What are the key takeaways?
David emphasizes strategic caution. He believes markets are overly optimistic about a Trump victory. Defensive investments are advisable, considering the numerous variables in play. It's essential to look beyond initial market reactions and consider the broader economic and political landscape.
Welcome to Thoughtful Money on YouTube. Today, we're diving into some fascinating financial trends with none other than Jan van Eck, CEO of Van Eck. Spoiler alert, if you're wondering what's driving markets through 2025, you're in for some enlightening info.
Absolutely. Jan shares his insights on everything from stock market dynamics to government spending and emerging technologies. Plus, with Van Eck managing over $100 billion in assets, we've got a front-row seat to expertise in action. Let's dig in.
So what's the big idea Jan's bringing to the table today?
Jan's core thesis is that despite a few looming challenges, several powerful macro trends are poised to steer the markets through 2025. These trends include shifts between growth and value stocks, soaring government spending, diversified global economic growth, and blockchain technology advancements.
Kicking things off with the stock market. What's happening with growth versus value stocks?
Jan highlights that growth stocks are experiencing an extreme surge, much like the late 90s tech bubble. He suggests that it's a prime time to diversify away from these mega-cap growth stocks to avoid getting caught in a potential downturn.
Interesting. Now, what about government spending? That seems like a hot topic.
Indeed. Despite low unemployment, the U.S. is running high budget deficits, contributing to economic resilience in 2023. However, looming entitlement spending might force a fiscal reckoning by 2025, potentially pushing long-term interest rates higher.
Got it. Now let's talk global growth. What's the outlook there?
Global growth is becoming more diversified, with countries like India, Brazil, and Saudi Arabia emerging as significant economic players. This shift is expected to positively impact financial markets, particularly in emerging markets with strong technological and economic reforms.
And last but not least, blockchain technology. What's the scoop?
Blockchain ecosystems like Ethereum are growing rapidly in usage. However, Ethereum faces intense competition, so its long-term success hinges on continued high volume and cost efficiencies. Blockchain isn't just hype, it's poised to be a substantial part of future commerce.
All right, time to gaze into that crystal ball. What's on Jan's prediction radar?
First up, he foresees a market rotation where mega-cap growth stocks pull back and other sectors rise. Investors should consider reallocating to avoid being heavily weighted in these high flyers.
Fair enough. And the fiscal reckoning?
Jan predicts a significant fiscal adjustment by 2025 as the government grapples with its burgeoning debt. If the market perceives mismanagement, we could see a spike in long-term interest rates.
Noted. What about emerging markets?
Countries like India, Brazil, and Saudi Arabia are expected to outperform with their accelerating economic growth, creating new lucrative investment opportunities.
And blockchain technology?
Blockchain tech will continue to grow, integrating deeper into global finance. This makes blockchain-related investments a smart play to future-proof portfolios.
With all this on the horizon, what should investors take away from Jan's insights?
Diversify away from overvalued mega-cap stocks, prepare for possible fiscal adjustments by 2025, capitalize on growing emerging markets, and keep a close eye on blockchain technology developments. Flexibility and proactive portfolio management will be key.
Welcome back to the David Lin channel on YouTube. Today's headline: Biden says he's out of the presidential race. Could it get any crazier?
Absolutely. The drama is off the charts. Matt Gertken, chief geopolitical strategist at BCA Research, joins us to unpack what this seismic shift means for both parties and the markets. Buckle up.
So what's the big picture takeaway from Biden dropping out?
Matt Gertken breaks it down. Biden's decision, forced or voluntary, is a game changer. It disrupts the Democratic campaign while offering Kamala Harris a chance to lead, but it also raises questions about the party's unity and strategy moving forward.
All right, let's hit the key points. Kick us off with Biden's announcement.
Biden's exit was driven by his declining competency, something even Democrats couldn't ignore. Kamala Harris steps up, but inheriting Biden's disorganized legacy is like getting handed a ticking time bomb.
Yikes, how about voter reactions?
Polling data didn't initially show dramatic shifts due to Biden's debate performance, but skepticism about his capability to lead spurred this drastic step. Approval ratings were stable, but with a notable dip post-debate.
Market implications.
Biden's dropout gave the market a short-lived boost, but don't pop the champagne yet. The fear of a Republican full sweep remains, with potential inflationary spikes and structural shifts being major concerns.
Got it. And the international chessboard?
Biden's tenure saw criticisms on inflation, open borders, and massive aid to Ukraine. Harris might up the ante in Ukraine, potentially sparking more significant conflicts with Russia.
All right, let's get the crystal ball out. What does Matt predict?
If Harris takes over soon, it might strengthen her position for re-election. Voters would then decide if they want to remove a sitting president. On the flip side, Republicans will likely concentrate their attacks on Harris while using Biden's flaws as her political baggage.
So wrapping up, what's the final word?
Biden stepping down, dents Democratic credibility, but gives Harris a fighting chance. Domestic concerns like inflation and joblessness, combined with international tensions, will be pivotal for voters. The roller coaster ride is far from over.
Welcome back to Blockworks Macro. Today we're dissecting a fascinating discussion with veteran bank analyst Chris Whalen. He's got his finger on the pulse of big bank earnings and what they mean for the financial landscape. Hold tight, it's going to be a wild ride through the world of credit, net interest margins, and commercial real estate.
Absolutely. Chris delves into the nitty-gritty of what's really happening behind those bank earnings reports and sheds light on some strategic maneuvers that aren't exactly front-page news. This one's a must-listen for anyone curious about the inner workings of our banking system.
So, what's Whalen's main takeaway from these bank earnings reports?
He zeroes in on how banks are aggressively managing their balance sheets, primarily through selling low-yield assets and engaging in synthetic risk transfers. This strategy aims to improve their financial standing amidst rising interest rates and tighter regulatory pressures.
All right, let's dive into the key points. What stood out to Whalen about these big bank earnings reports?
Well, banks like JP Morgan and Bank of America have reported, showing a real squeeze on their net interest margins. All banks seem to be earning less on their loan portfolios while paying more on deposits. It's like trying to squeeze juice out of a flat lemon.
And what's the deal with these synthetic risk transfers?
Banks are essentially offloading part of their credit risk to hedge funds and insurance companies. They pay a fee, but in return it lowers their risk-weighted assets and frees up capital for more profitable opportunities. It's financial engineering at its finest.
Speaking of risks, what about commercial real estate?
The real estate conundrum. Banks are dealing with commercial real estate that's teetering on the edge. Properties in New York, for example, are going into foreclosure. Banks prefer to extend terms or ask for cash injections from borrowers rather than take them over.
Whalen doesn't shy away from making predictions. What does he see in the financial crystal ball?
He predicts more bank failures due to the combination of flat net interest margins and rising credit costs. Smaller banks could especially be at risk. Also, commercial real estate defaults will continue in a slow, steady manner. Think a leaky faucet, not a bursting dam.
So what's Whalen's final word on all this?
He wraps up by stressing the need for solid strategic management in banking. His key advice? Banks must focus on balance sheet optimization and realistic asset restructuring plans. He also offers a heads up about ongoing commercial real estate issues and the importance of being prepared for more bank failures.
Welcome to Kitco News. We've got a blockbuster episode for you today. Major upheavals in the political arena, surprising market moves, and a tech snafu that's causing quite a stir. Joining us to break it all down is financial whiz Bill Baruch, president of Blue Line Futures.
Absolutely. Bill's here to dissect the latest monumental updates in U.S. politics and how they're shaking up gold, stocks, and Bitcoin. Let's dive in.
All right, let's start with the big news. President Joe Biden is dropping out of the 2024 race and has endorsed Kamala Harris. What's the main thesis of this episode?
The main thesis revolves around how Biden's exit creates significant political uncertainty, which has rippled through various markets like gold, stocks, and Bitcoin. Investors are now dealing with a different set of dynamics.
Let's break it down. First up, the political shift. What's going on there?
Biden's exit leaves a vacuum. While Kamala Harris has his endorsement, she hasn't clinched the nomination yet. Big names like Hillary Clinton and George Soros are backing her. But there's chatter about an open convention. Expect hot drama in August.
Next, gold seems to be glittering. What happened there?
Gold futures soared to a high of $24.63 per ounce last week. As political uncertainty makes investors jittery, they're turning to safe haven assets like gold. Currently, it's holding just below $2,400, showing surprising stability.
Interesting. Now, the tech world isn't drama-free either, is it?
Absolutely not. CrowdStrike, a cybersecurity firm, faced a major IT outage due to a software update glitch, dropping their stock by 11%. Adding fuel to the fire, their chief security officer sold 4,000 shares just days before the outage. Talk about timing.
And what's this about the Trump trade?
Oh boy, the Trump trade. With Trump potentially eyeing a return to the White House, markets are mixed. J.D. Vance as his VP pick is boosting Bitcoin. Investors are anticipating major policy shifts, particularly around deregulation and onshoring.
Let's look into the crystal ball. What predictions are we seeing from Bill?
First off, brace yourself for market volatility due to political instability. Investors should be vigilant, especially in sectors like energy and tech. Secondly, the Fed might expedite rate cuts due to the newfound uncertainty. Upcoming data, especially from the Personal Consumption Expenditures Report, will be crucial.
All right, let's wrap it up. What are the key takeaways for our viewers?
Bill Baruch emphasizes staying nimble and cautious. Keep an eye on political developments, particularly the Democratic National Convention in August. Use market dips strategically, but always stay on the side of caution. It's a wild ride ahead.
Brian Kim from ClearValue Tax sees no immediate housing crash despite record prices and predicts stable rates with slight mortgage drops.
Michael Burry anticipates economic downturns by moving into Chinese tech and gold, seeing potential in undervalued assets.
Meanwhile, Jeff Snyder warns of China's systemic dollar shortage and its global impacts.
David Wu raises red flags about misinterpreted Trump trades, stressing defensive investments.
Jan Van Eck advises diversification against mega-cap stocks and highlights emerging market opportunities.
Matt Gertken discusses Biden's resignation's potential market impacts, while Chris Whalen notes bank strategic moves amid rising credit costs.
Bill Baruch foresees market volatility with the Fed likely to cut rates, urging cautious optimism.
Our experts align on economic challenges, differing on investment safe havens like gold, traditional assets, and cryptocurrencies.
Thanks for watching Financial Insights in Minutes for July 23rd, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.